An interest bonus can cover the cost of insurance. In this episode, I'm going to address what is an interest bonus on an indexed universal life insurance policy and how it can cover the cost of insurance. My name's Doug Andrew, and I've helped many people prepare for a comfortable retirement, to not outlive their money, and I do that by directing them and educating them on superior capital accumulation vehicles. Now, sometimes people hear capital accumulation. What's that? That's money, okay? Money is capital. And I've helped many people optimize their financial assets and have their money earn more than they do, even by age 32. The favorite instrument that I use for serious cash is what I call the laser fund. In so much that I have a book by that title, Laser Fund, and I'll gift you a copy of this 300-page book at the end of this episode because, I'm 69 years old right now and I'm passionate about enlightening and educating as many people as possible before I graduate, so to speak. So I am passionate about giving you insights into opportunities that maybe you didn't know existed before. And my favorite vehicle is the Laser Fund, where I recommend that people, as they approach retirement, that they allocate 40 to 60% or more, some people do 100% of their money, into what I call the tax-free bucket. And by far, the best instrument in that bucket that allows you in America to accumulate your money tax-free and then be able to access the money tax-free. If you retire at age 60, we have some people retiring when they're 35, okay? But whenever you start taking out income, you don't have to wait till you're 59 and a half or anything like that, but you can take out income tax-free for as long as you live, if you live to be 120. And the average returns when a laser fund is structured correctly and funded properly, the returns have been between 7 to 10%. Now, many years, it's much higher than that. Some years, when the market crashes 40%, our clients have not earned anything, but they haven't lost a dime. So the strategy is called indexing, and there's a lot of episodes on this very channel that talk about indexing and how you can diversify using different indexing strategies. And I would encourage that you watch those. And also, I want you to take advantage of reading this book that I'm going to gift you at the end of this particular episode. But when people learn about indexed universal life, they start hearing different terms, such as linking. Linking means you're not letting the insurance company take your money and put it at risk in the market. You're linking your return to an index like the S&P, Standard & Poor's 500, the Dow Jones, the Russell 2000, whatever. It means that your money always stays safe in the insurance company, earning the general account portfolio rate that the insurance company earns on their investment portfolio. And they usually invest in very conservative investments. That's why there's never been a legal reserve insurance company not honor a legitimate claim. They've weathered the Great Depression with flying colors when 40% of banks never reopened again after the Great Depression. In 2008, 400 banks went under. Not one single legal reserve insurance company went under in 2008. In fact, this is where many banks who stayed afloat would put 30 to 40% of their Tier 1 assets. What's a Tier 1 asset? It's money that banks and credit unions have to have liquid, on hand, and safe in case of a run on the bank or credit union, people rushing the bank to withdraw their money. They put it into insurance companies for liquidity and safety. If you connect the dots here, you can bypass the middleman, is what I'm saying. You don't have to have your money in a bank for liquidity and safety when banks are simply taking your money and putting it into insurance companies to increase the liquidity and safety by 6 notches. So bypass the middleman for long-term goals. A bank or credit union might be good for a 6-month goal where you're saving up for a car or a jet ski or a boat or something or a baby in 9 months, but do not use banks and credit unions for long-term goals. You use long-term investments for long-range goals, and that's why a maximum funded indexed universal life policy, when it's structured properly and funded correctly, will knock the socks off of most IRAs and 401ks, other types of mutual funds and investment accounts, because you don't lose when the market goes down and you make money when the market goes up, but it's tax-free. I only have to earn 9% and net 8% after the cost of insurance is deducted in Index Universal Life. If I have my money in the market, I have to earn 12% or more to net 8% because I have to pay tax in an IRA or 401k. There's fees on it and so forth. And so I prefer tax-free returns rather than tax-deferred or taxed as earned rates of return in a portfolio of mutual funds. When we look at Universal Life, the linking means your money is not at risk in the market. Then you can link your returns to a 1-year point to point. So they measure from, let's say, July 15th. If you linked in July, you can do it any month you want, to July 15th of the next year, and then they credit you up to a cap of whatever the S&P did. If it went from 1,000 to 1,100, they'll credit you that 10% increase. If you have $1 million in your policy, they just credited you $100,000. They can afford to do that because the options that they purchased with the interest on your money, because they can't risk your money in the market. Your money has to stay safe in the insurance company. The interest on your money is what you sort of relinquished to buy upside options. But if the market crashes, those options expire worthless, and you don't earn anything, but you didn't lose your principal, your million you started with. So indexing is a great way to participate when the market goes up and not lose when the market goes down. You can use 1-year point to point. You can link 2-year, going from a specific, like October 15th of 1 year, and 2 years later, you measure the upside, and the caps might be as high as 19%, or no cap, but they'll subtract a threshold or a spread. And this is where many times people realize 19 or 20% over a 2-year period, waiting for 2 years. Some use a 5-year strategy. You wait 5 years, they smooth out the last year and average the last 12 months, and people are able to sometimes get a 50% return over a 5-year period by using a 5-year strategy. Now, the last thing that people usually ask is, well, what's an interest bonus on a universal life policy? So how can this interest bonus benefit you in the long haul when you purchase an indexed universal life policy as a long-term strategy? Get ready, I'm going to blow you away. So many insurance companies will offer an interest bonus. It may not be a lot, and they will do that maybe starting the 11th year. Some companies do it sooner, but they will pay you a bonus on top of the normal interest they're crediting you, starting the 11th year until maybe the 35th year, or as long as you own the policy. It could be 30 basis points. That's 0.3%. So if you had $1 million in cash value inside your IUL policy, and you got that kind of a bonus, that would be an extra $3,000. They credit you at the end of the year, starting the 11th year on the $1 million. That $3,000 may not sound like a lot, but if you understand maximum funded indexed universal life, if you started out with $500,000, like many of our clients did, and in 7 to 10 years, that $500,000 in the policy grew to $1 million, the original death benefit required by the IRS that it qualifies to be tax-free for a 60-year-old may have been $1,250,000. You could buy way more insurance than that, but that's not the objective. Your objective is to take the least amount of insurance the IRS will let you get away with. So at age 60, if you want to sock away $500,000 and have it grow like crazy, you take the least amount of insurance. That would be about $1,250,000. Now, when that $500,000 grows to $1 million, the net amount at risk is only the remaining $250,000. You're self-insuring. So if that $1 million doubles again in 7 to 10 years, which for many of our clients it did, the $1 million doubles to $2 million, that's more than the death benefit. So now the death benefit stays ahead of the cash value by 5 percentage points. So if you have $2 million of cash, the death benefit is actually $2,100,000. The cost of that net amount at risk is so minuscule at that point in time that the interest bonus, in this example, $3,000, easily, slam dunk, covers the cost of insurance the rest of your life. So basically, the insurance is free. You're self-insured, and any cost for the insurance is covered by a little tiny interest bonus. Why do the companies do that? Because they're rewarding you for persistency, for being a loyal client. And so many times these are called different things. They could be called additional credit or a persistency credit, or a conditional credit, conditional upon you doing this. Sometimes they're guaranteed bonuses. Sometimes they're not guaranteed. It's based upon the profitability of the company, which brings me to understanding the difference between insurance companies. Basically, there are two types of insurance companies, stock and mutual. Now, there's employee-owned companies and so forth, but a stock company has to sort of look out for their stockholders. So often, a stock company is a little bit more stingy to the policyholders because they're trying to make a profit because their first allegiance is to their stockholders. So when you want to see interest bonuses and to have the best net internal rate of return, because over 20 or 30 years, an extra 1/3 of 1% adds up. Usually a mutual company, which is mutually owned by the policyholders, will actually perform better on the average, not always. And so if you're looking for an interest bonus to be able to help you offset the cost of insurance so that in the long run, if you earned 11, you're going to net 10 or more, or if you earn 9, you net 8 or more, you might want to consider a mutual company and a company that offers an interest bonus, and then put in the maximum the IRS allows as fast as they allow. And within the 10, 11-year period, watch. By the 15th year and thereafter, the interest bonus will likely cover the entire cost of the insurance the rest of your life on that policy. The insurance is just sort of coming along for the ride. And that sounds pretty good to me. So if this is intriguing you, where can you learn more? Well, this is why my 11th book that I co-authored with my two sons, Zimmerman and Aaron, they're two of the top IUL specialist professionals in America. It's in its 8th printing, 3rd edition. And so we constantly revise this. It's actually 2 books in one, and I want to gift you a copy. So this white covered side is about 200 pages, 14 chapters that have all the charts and graphs and explanations. And chapter 6 of this side goes in depth into indexed universal life, how it works, the various indexing strategies you can use, and there's actually a subsection on interest bonuses there if this video needs more clarification in your mind. But if you learn by stories and examples, you flip it over and read this one. If you're a right brain learner, this is about 100 pages, 12 chapters with 62 actual client stories of how the laser fund is used not only for retirement that knocks the socks off of traditional IRAs and 401ks, but emergency funds, college funding, working capital for business, real estate management, estate planning, on and on and on. And if you want to use your whole brain, your right brain and your left brain, you can read both, okay? But here's how you can claim your free copy. You simply go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. And then I will fire out a copy to you. This is about you and your brighter future. And when you do that, there's options there to listen and learn, the audio version, watch and learn. There's even an 18-hour masterclass that my two sons and I teach that you can invest in to be able to take ownership of your brighter future. Because I'm about empowering you to be able to take control of your brighter future and make yourself immune from the negative impact of taxes, inflation, and market volatility. That's why I recommend that 40 to 60% of your retirement assets be repositioned at retirement into a portfolio of laser funds. You'll understand why when you read. So claim your free copy, and here's to your brighter future.